Most traders treat diagonal spreads like fancy calendars, but ignoring the directional delta component is the fastest way to turn a winning trade into a maximum loss. Both strategies involve buying a long-term option and selling a short-term option, but the strike price selection changes everything. A calendar spread targets a specific price pin, while a diagonal spread targets a directional drift. Let's define the calendar spread first. You are buying time and selling time at the exact same strike price. This creates a tent-shaped profit zone that profits most if the stock goes nowhere. The diagonal spread introduces a directional bias by moving the long option strike deep in the money. This structure mimics owning the stock or shorting the stock, but with defined risk and lower capital requirements. Here is the critical Greek breakdown. The calendar is a neutral trade with near-zero delta, but massive vega exposure. The diagonal sacrifices some vega to gain delta, giving you profit potential from price movement. Let's look at the delta equation for a long call diagonal. Your long option has a high delta, perhaps 0.80, while your short option has a lower delta, say 0.30. This creates a net positive position. This positive net delta means the diagonal spread behaves like a poor man's covered call. You want the stock to rise, but slowly, staying below your short strike to capture the premium decay. Conversely, the calendar spread hates movement. If the stock moves too far in either direction, you slide down the sides of the profit tent and start losing money, regardless of time decay. Now consider volatility. Calendars are pure volatility plays. They need implied volatility, IV, to rise or stay high. If IV crashes, the long option loses value faster than the short option, crushing the trade. Diagonals are more resilient to IV crush. Because the long option is deep in the money, IDM, it consists mostly of intrinsic value, which is not affected by changes in implied volatility. This leads to a crucial decision regarding debit paid. Calendar spreads are generally cheaper to enter. Diagonal spreads are more expensive because you are buying intrinsic value in that IDM leg. However, cheaper does not mean better. The calendar has a lower probability of profit because it requires the stock to land on a pinhead. The diagonal offers a wider margin of error directionally. Let's visualize the payoff curve evolution. As time passes, the calendar's profit peak rises sharply near expiration. The diagonal's profit line simply lifts higher across a broader price range. So when should you use a calendar? Use it when you are neutral on price, but bullish on volatility. Think earnings run-ups or finding a bottom in a low IV stock. When should you use a diagonal? Use it when you have a directional assumption but want to reduce your cost basis. It is the perfect substitute for buying stock when IV is elevated. Management also differs significantly. With a calendar, if the stock breaches your strikes, you must close or roll. There is very little room to adjust because you lack intrinsic value. With a diagonal, if the trade moves against you, you can often roll the short leg down for calls or up for puts to collect more credit, reducing your max risk further. Beware the volatility trap in calendars. If you buy a calendar when IV is already high, like earnings, the subsequent volatility crush can wipe out your profit even if the price stays perfect. For diagonals, the main risk is early assignment. If your short leg goes IDM and there is a dividend approaching, you are at risk of losing your long position to cover the short. Here is the final decision matrix. Ask yourself, do I expect the stock to move? If no, calendar. If yes, diagonal. Is IV low? Calendar. Is IV high? Diagonal. Ultimately, the diagonal is the more versatile, robust strategy for daily trading, while the calendar is a sniper rifle for specific low volatility, neutral situations. Master the Greeks, choose your direction, and trade smarter.